Is Europe on the brink of economic collapse? Two of its economic heavyweights, France and Italy, are on the edge of a financial cliff. What's pushing them over? Trade wars, exploding deficits, and mounting national debt. But what does this mean for the average citizen? And can they survive the economic storm brewing between the EU and China? France is currently grappling with a staggering fiscal crisis, characterized by a national debt that has soared to over 3 trillion euros. To put that into perspective, this figure eclipses the entire economic output of the country, which was around 2.78 trillion euros in 2022. According to INSEE, the National Institute of Statistics and Economic Studies. The implications are profound. The Financial Times reported that France's debt-to-GDP ratio now stands at an alarming 113%, raising concerns about fiscal sustainability and potential default. Jean Pisani-Ferry, a prominent economist and former advisor to the French government, stated, "The structural weaknesses in the French economy, high public spending, low productivity growth, and stagnating reforms, have created a ticking time bomb." Alongside its debt crisis, France is facing an escalating trade deficit, now ballooning to over 5 billion euros per month. Italy is also navigating turbulent waters under Prime Minister Giorgia Meloni. Italy's fiscal deficit has reached approximately 120 billion euros, mirroring France's economic challenges. The country's debt-to-GDP ratio is a staggering 145%, the second highest in Europe, according to Eurostat. Meloni's government is caught in a bind as rising inflation and energy costs threaten to worsen the already fragile economic landscape. Italy's reliance on tourism, which constitutes 13% of its GDP, makes it particularly vulnerable to global economic shifts. Sandro Gozzi, an Italian politician and economist, remarked, "Italy's economic woes are not isolated. They reflect broader trends across Europe, exacerbated by the energy crisis and shifting trade dynamics. And with all of this economic storm, the EU is escalating a trade war with China." The recent imposition of tariffs on Chinese electric vehicles by the EU, with strong support by France and Italy, has raised the specter of a trade war. Experts warn that such conflicts could have dire consequences for global trade stability. The European Commission reported that the tariffs are intended to protect European manufacturers, but they risk provoking retaliation from China, which could escalate tensions and disrupt supply chains. Willem Buiter, a global economist, noted, "Trade wars seldom have winners. They create uncertainty and stifle economic growth, impacting consumers and businesses alike. If you are enjoying our content, please hit the like button. To help us even more, please leave your thoughts and feedback in the comments. Your engagement helps us grow. Thank you." So, how is China responding to the EU's tariffs? China has imposed retaliatory measures on European products, including EU brandy, a key export valued at over $1.7 billion annually. This move signals a broader economic battle that could extend to various industries, including automotive and machinery. The potential fallout is significant. The Institute for International Finance cautioned that such retaliatory tariffs could lead to a 5% decrease in exports to China for affected sectors, translating to billions in lost revenue. Bruno Le Maire, France's Minister of Economy and Finance, stated, "This retaliatory action jeopardizes not just our brands, but also the livelihoods of thousands who rely on these industries." The trade war's impact on luxury giants like LVMH and Remy Martin cannot be overstated. These companies represent the epitome of French luxury, contributing significantly to the national economy. LVMH, for instance, recorded revenues of 64.2 billion euros in 2022. But trade tensions pose a serious risk to their market stability. Market analysts predict that retaliatory tariffs could decrease sales by up to 15% in the Asian market, which is vital for these luxury brands. This situation underscores the fragility of the French economy, heavily reliant on its luxury sector. Bernard Arnault, CEO of LVMH, expressed concerns, saying, "The luxury market thrives on stability. Disruption jeopardizes not only our profits but also our heritage and craftsmanship." European automakers are also feeling the pinch in China. Brands like BMW and Mercedes-Benz are losing ground as rising tariffs and increasing competition from local manufacturers threaten their market share. In 2022, BMW's sales in China fell by 8%, while Mercedes-Benz saw a decline of 12%, according to industry reports from Jado Dynamics. This decline is alarming, especially as China accounts for a substantial portion of these companies' global sales. The increased tariffs further squeeze profit margins, forcing automakers to reconsider their strategies in this crucial market. Carlos Tavares, CEO of Stellantis, remarked, "To remain competitive, we must adapt quickly. Failure to do so may lead to irreversible losses." China's strategic pivot towards local sourcing of components presents a formidable challenge for European automakers. Companies like Volkswagen, heavily reliant on exporting parts to China, face existential risks. Recent data suggests that 80% of components for electric vehicles are now sourced domestically in China, diminishing the demand for European exports. The ramifications are severe. If Chinese manufacturers can achieve parity in quality and technology, European automakers could face significant market losses. A report from McKinsey & Company estimates that this shift could cost European automakers 30 billion euros in lost revenue over the next 5 years. Herbert Diess, former CEO of Volkswagen, stated, "The race is on, and if we don't innovate quickly, we risk becoming obsolete in our largest market." The potential plummet of automotive exports to China carries dire long-term consequences for Germany. Given that the automotive sector represents 20% of Germany's exports, a significant downturn could trigger widespread economic turmoil. The German Association of the Automotive Industry estimates that a 30% drop in exports could result in the loss of hundreds of thousands of jobs. Moreover, the German economy relies heavily on this sector for innovation and growth, meaning that a decline in automotive exports could stifle economic development across multiple industries. Volker Bouffier, former vice minister of the state of Hesse, cautioned, "The automotive industry is the backbone of our economy. Any shock here reverberates through the entire economic fabric." The EU's decision to impose tariffs on China is not just a regional issue. It's driving a wedge between Europe and its major trading partners. According to a report from the World Trade Organization, this could lead to a 6% decline in global trade volumes if tensions escalate. The stakes are incredibly high. A global economic crisis could be triggered if trade tensions spiral out of control, affecting economies far beyond Europe and China. The interconnected nature of modern economies means that disruptions in one area can lead to ripple effects worldwide. Roberto Azevedo, former Director General of the WTO, stated, "We must find a way to resolve these disputes without resorting to tariffs, as the consequences are often more damaging than the issues at hand." But is the EU listening? Europe now finds itself caught between a protectionist US and a retaliatory China. This geopolitical tug-of-war complicates trade relationships and could lead to long-term economic ramifications. As outlined in a recent article by The Economist, the risk of becoming collateral damage in a larger conflict is increasing. The implications for the future of the global economy are significant. If Europe cannot navigate these tensions wisely, it may face economic isolation, affecting its role as a leading global player. Geeta Gopinath, chief economist of the IMF, warns, "Europe must tread carefully. A misstep could lead to a fragmentation of global trade systems, impacting growth and prosperity worldwide." To avoid deepening the economic crisis, critical decisions must be made in Brussels. Policymakers need to focus on fostering innovation, supporting vulnerable sectors, and enhancing trade relationships without resorting to protectionism. The European Commission has emphasized the need for a balanced approach to trade, which could involve negotiations aimed at reducing tariffs and promoting collaboration. The most urgent uncertainties moving forward include the potential for further retaliatory measures from China and the impact of U.S. economic policies on European markets. As we move into an increasingly interconnected future, the ability to navigate these challenges will determine the trajectory of Europe's economic stability. Ursula von der Leyen, President of the European Commission, stated, "We must strive for a fair and open trading system that promotes growth and resilience, ensuring that Europe can thrive in the face of global challenges." The stakes are high, and the consequences of inaction could reverberate throughout Europe and beyond. As citizens, businesses, and policymakers confront these challenges, the future of the European economy hangs in the balance. We hope you are enjoying this video. We're thrilled to have you with us today. If our content struck a chord or sparked some inspiration, go ahead and smash that like button and hit subscribe to join our awesome community. Please share this video to help us grow. Your support is super valuable. Check out another video from our channel, which is now on the screen.